Inside the pages of every major financial collapse in recorded history, there is a pattern so consistent, so undeniable, that economists and historians keep finding the same handful of assets, sitting on the other side of the wreckage, completely intact. The Roman Empire, the Weimar Republic, the Great Depression, the 2008 financial crisis, Argentina, Venezuela, Zimbabwe. Every single one of these economic catastrophes wiped out fortunes overnight. And yet, certain people walked away wealthier than when it started. Not because they got lucky, not because they had insider information, but because they owned specific assets that have a nearly perfect track record of surviving every financial collapse in human history. Today, I'm going to show you exactly what those 6 assets are. And more importantly, I'm going to show you why they work. Because understanding the mechanism is what separates the people who panic and lose everything from the people who stay calm and come out ahead. We're going to go through each one in order, from the ones you've probably heard of, to the one at the very end that almost nobody talks about, but that has arguably the most powerful track record of all. So stay with me, because by the end of this video, you are going to have a framework for protecting your wealth that has been tested, not in a spreadsheet or a theory, but in the actual fires of history. Before we dive in, I want to set something up for you, because context here is everything. When economies collapse, they don't just collapse for no reason. There's always a mechanism. There's either a currency crisis, meaning the money itself loses its value. Or there's a credit crisis, meaning the system of debt and lending seizes up. Or there's a sovereign crisis, meaning the government itself starts to fail. Sometimes it's all 3 at once, which is when things get truly apocalyptic. And here's the thing that most people don't understand. The kind of asset that protects you depends heavily on which type of collapse is happening. Gold does brilliantly in a currency crisis, but can be complicated during a pure credit crisis. Real estate can thrive or completely collapse depending on who's printing money and whether debt is involved. So as we go through these 6 assets, I'm going to tell you not just that they work, but when and why they work, so that you can make intelligent decisions based on what's actually happening in the world around you right now. Asset number 1 is gold. And yes, I know you've heard this before, but I want to go deeper than most people do, because the surface level answer of just buy gold is actually incomplete and sometimes wrong. Gold has been a store of value for over 5,000 years. That alone is remarkable. And think about that for a second. Every currency that has ever existed has eventually failed. Every single one. The dollar, the euro, the pound, the yen, every fiat currency in history has eventually been inflated away or collapsed entirely. Gold has outlasted all of them. During the Weimar Republic hyperinflation in Germany in the 1920s, the German mark became so worthless that people were burning it for heat. Because the firewood cost more in marks than the marks themselves were worth. People were using wheelbarrows full of cash just to buy a loaf of bread. And in that environment, gold didn't just hold its value. It massively appreciated in purchasing power relative to the collapsing currency. An ounce of gold bought more in 1923 than it did in 1920. Not because gold became more valuable in an absolute sense, but because everything else became nearly worthless. Here's the deeper point, though. Gold is not an investment. And if you go into gold thinking of it as an investment that should beat the stock market, you will be disappointed and you will make mistakes. Gold is insurance. It is the financial equivalent of a fire extinguisher. You don't buy a fire extinguisher expecting it to make you money. You buy it because if the fire happens, you will be extremely grateful you had it. The people who do best with gold are the ones who understand this distinction. They hold a portion of their wealth in gold, they don't obsess over the price day to day, and then when a crisis hits, that portion of their portfolio doesn't just hold steady, it often surges. Now, one important caveat on gold. Physical possession matters enormously during a true collapse. Paper gold, meaning ETFs and futures contracts, can behave very differently from physical gold when financial systems start to break down. The people in Germany and Argentina who had physical gold coins or bars in their possession were in a completely different situation. From people who held gold on paper through financial institutions that were themselves in trouble. That distinction is critical. Asset number 2 is land, specifically productive land, and I want to make that distinction clear right from the start. Not all real estate is created equal during a financial collapse, and this is where a lot of people get confused. We saw in 2008 what happens to over-leveraged real estate when a credit crisis hits. Housing prices collapsed by 30 to 50% in some markets. People who had taken on enormous amounts of debt to buy properties that were generating no income were wiped out. But here's what didn't collapse: farmland, productive agricultural land, land that actually grows things that people need to eat. Because here's the fundamental truth about land. You can inflate away a currency, you can default on debt, you can crash a stock market, but you cannot print more land. The supply is fixed. And if that land is producing food, it becomes even more essential. Because food is the one thing that no economy, no matter how collapsed, can stop needing. Look at what happened in the Soviet Union's collapse in the early 1990s. People who had access to land, even small plots, were able to grow food and either feed their families or trade their produce for other goods. The currency had collapsed, the state had collapsed, but the land was still there and it was still producing. Same pattern emerged in Argentina's 2001 collapse. The landowners in the agricultural provinces were largely insulated from the financial carnage happening in Buenos Aires. Land also has this extraordinary property during inflationary collapses specifically. Because land is priced in whatever currency is being inflated, its nominal price rises along with inflation, meaning it acts as a natural inflation hedge. But unlike gold, productive land also generates income, actual agricultural income, rental income, resource extraction income, which means it has both the inflation protection of a hard asset and the cash flow generation of an income-producing investment. That combination is extraordinarily powerful during financial instability. We're about a third of the way through, and I want to pause for a moment and acknowledge something. These assets that we're talking about are not exotic. They're not complicated. They're not things that require a PhD in finance to understand. And I think that's actually the most powerful insight here. The assets that survive financial collapse are consistently the oldest, most fundamental, most basic forms of wealth in human history. When sophisticated financial engineering fails, and it does fail, people always run back to the basics. Keep that in mind as we continue, because it applies to every single asset on this list. Asset number 3 is commodities, specifically storable commodities, and this is where things get really interesting from a historical perspective. When currencies collapse, physical goods take on an extraordinary importance because they become a kind of money in themselves. During the German hyperinflation, cigarettes became a de facto currency. During World War II prisoner of war camps, there are documented historical records of cigarettes being used as currency among prisoners. During Venezuela's ongoing collapse, basic goods like flour, cooking oil, and medicine became more valuable in trade than the bolivar. This is not a coincidence. This is a pattern that repeats every single time a currency fails. The economy doesn't disappear when the money disappears. People still want to trade. They still want to exchange value. And when fiat currency fails, they reach for whatever is universally needed, universally recognizable, and impossible to infinitely create. Now, the challenge with commodities as a personal wealth strategy is practical. You can't personally stockpile millions of dollars worth of oil or wheat, but there are ways to get exposure. Agricultural commodities through land, as we just discussed, precious metals like silver, which straddles the line between a commodity and a monetary metal, energy resources, and for more sophisticated investors, commodities futures and commodity-focused businesses. But even at the personal level, there is genuine historical precedent for people protecting wealth through storable goods during inflationary crises. The households in Weimar Germany that had stocked up on physical goods before the hyperinflation peaked were able to weather the storm far better than those who had their savings purely in cash. Asset number 4 is foreign currency, specifically hard currencies, and this one requires careful thinking because it might seem counterintuitive. If currencies are dangerous, why would a currency protect you? The answer is that not all currencies are equally vulnerable to collapse. During Venezuela's collapse, people who held US dollars were protected from the bolivar's destruction. During Argentina's repeated currency crises, people who had dollars in offshore accounts or physical dollar bills in their homes maintained their purchasing power while those with only pesos watched their savings evaporate. During the Weimar hyperinflation, people who held foreign currencies like British pounds or American dollars were essentially immune to the mark's destruction. The pattern here is geographic and institutional diversification of currency exposure. The risk is concentrated in whatever currency is collapsing. Holding a different currency eliminates that specific risk. The important caveat here, though, is that this strategy is most powerful when one country is experiencing a crisis while the rest of the world is relatively stable. In a truly global financial collapse, even the so-called hard currencies face pressure. We saw a version of this in 2008 when even the dollar faced stress as the global financial system teetered. In that kind of environment, the other assets on this list become more critical than foreign currency exposure. So foreign currency is best understood as a hedge against localized collapse rather than a global systemic collapse. But given that most financial catastrophes in history have been localized, meaning they happened to one country or one region, while the rest of the world continued functioning, this is an extremely valuable tool. Now we're getting into the assets that fewer people talk about, and this is where I think the real insight is. Asset number 5 is equity in essential businesses. And I want to explain exactly what I mean, because this is not the same as just saying buy stocks. During the Weimar hyperinflation, one of the most counterintuitive things that happened was that the German stock market actually performed reasonably well. In real terms for shareholders who owned equity in companies that produced real goods, the The shares represented ownership in real physical assets, factories, equipment, inventory, land holdings of the company. As the mark collapsed, the nominal value of those shares rose with inflation. And for companies that were in essential industries, meaning they were producing things people actually needed, regardless of economic conditions, their businesses continued to function and even thrive because their costs and revenues both inflated together. This is a crucial point. Businesses that produce essential goods or services have a built-in pricing power that protects them during inflationary crises. A food producer, a utility company, a medical goods manufacturer, these businesses can raise their prices along with inflation because their customers cannot choose to stop buying food, electricity, or medicine. But not all businesses have this protection. Luxury goods companies, businesses that depend on consumer discretionary spending, highly leveraged companies with lots of debt can be devastated during financial crises. The key filter is essential. Does the business produce something that people need regardless of economic conditions? If yes, equity in that business has historically shown remarkable resilience. If no, that equity can go to near zero very quickly. We saw this distinction play out dramatically in 2008, when companies like Walmart actually gained market share during the financial crisis. Meanwhile, companies in luxury retail, speculative real estate, and pure financial services were decimated as credit markets froze and consumer spending collapsed. The lesson the market taught us in 2008, the same lesson Weimar Germany taught us in the 1920s, is that essential businesses are a fundamentally different category of investment. Okay, we're at asset number 6, and this is the one I promised you at the beginning, the one that almost nobody talks about. I want to build up to this properly because I think it deserves the historical context that makes its power clear. Throughout history, the single most durable form of wealth, the one that survived not just financial collapses but civilizational collapses, is human capital. Specifically rare and valuable skills. The Romans documented it. Renaissance families understood it. Old aristocratic families of Europe protected it for centuries, as carefully as land or gold. Let me explain why this is so powerful and why it consistently outlasts other forms of stored value. Every other asset on this list can be seized, taxed, inflated away, or made inaccessible by government action or social instability. Gold can be confiscated. And the United States government literally did this in 1933 when Franklin Roosevelt signed Executive Order 6102. That order made it illegal for private citizens to hold gold, and I required them to hand it over to the Federal Reserve. Land can be nationalized. Foreign bank accounts can be frozen. Business equity can be destroyed by regulatory action or hyperinflation. But nobody can take what's in your head. A genuine, rare, high-value skill goes with you wherever you go. It cannot be confiscated, and it often becomes more valuable, not less, during times of economic stress and institutional breakdown. Think about what happened during Argentina's collapse in 2001 and how different groups experienced radically different outcomes. Doctors, engineers, skilled tradespeople were able to emigrate to more stable countries and immediately command high incomes. Their skills were portable and in demand globally, while those who held wealth in Argentine pesos watched it evaporate. The skill itself was the survival asset when the financial system failed and the currency collapsed. Think about the collapse of the Soviet Union and the transition to a market economy in the 1990s. The people who had technical skills, programming, engineering, medicine, were able to transition and even thrive in the new system. Those who had depended entirely on the Soviet state for income without developing marketable skills faced genuine desperation. Medieval guilds understood this principle intuitively long before modern economic theory articulated it. The knowledge of how to create Venetian glass, produce certain dyes, or design specific architectural elements was treated as wealth itself. That knowledge was guarded as carefully as gold, and guild members were protected and compensated even during political and economic instability. The skill was the asset, and it retained value across regimes, wars, and monetary upheavals. Now translate this to the modern world and ask what the equivalents of rare, high-value, irreplaceable skills are. Medical expertise. Engineering at the frontier of important technologies, the ability to solve complex financial problems or manage critical systems, the ability to create, to build, to make things that people need, regardless of economic conditions. These are not just career assets. They're wealth preservation assets of the highest order. I want to address something you might be thinking right now because it's a practical and important question. You might be thinking, this all sounds reasonable, but how does knowing this change what I actually do today? The best time to position yourself for a financial crisis is before the crisis happens, not during and definitely not after. During a crisis, the assets that protect wealth become extremely expensive and difficult to acquire. Gold prices spike, land becomes illiquid. Storable commodities disappear from shelves, foreign currency becomes restricted. During Argentina's 2001 collapse, the government froze bank accounts, literally preventing people from accessing their own money. During the 1933 gold confiscation, There was a window of weeks before the law went into effect. The people who moved fast were protected. The people who hesitated lost that window forever. This is the psychological trap most people fall into without realizing it. They know intellectually that they should be taking steps to protect their wealth, but the urgency to do it today does not feel pressing. And then when the crisis does happen, it happens fast and with brutal speed. In Venezuela, the Bolivar lost 99% of its purchasing power in just a few years. In Weimar Germany, the most catastrophic phase of hyperinflation happened in a matter of months. People who were financially stable in early 1923 were destitute by the end of that same year. The window for preparation closed almost overnight, and those who waited were trapped. So let me give you a practical framework for thinking about your own situation. Think about your current financial structure and ask what percentage of your wealth is concentrated in a single currency. What percentage is in assets that can be easily inflated away or are tied to one country's financial system? Then ask yourself what you would want to hold if your country's currency lost half its value in the next 12 months. If you can answer that question with genuine confidence, you are in better shape than most people. If that question makes you uncomfortable, that discomfort is information worth paying attention to. I want to circle back to something we touched on earlier because the historical consistency of this pattern is remarkable. We are not talking about an abstract theory or a model economists built and back-tested. We are talking about actual human beings across centuries and civilizations whose experiences were recorded. And when you examine those records, the same pattern appears over and over again without exception. The people who survived and thrived had exposure to real assets: hard money, productive land, storable goods, hard currencies, essential businesses, and irreplaceable skills. The people who were wiped out concentrated their wealth in financial instruments tied to collapsing currencies or credit systems, paper money, government bonds, unproductive debt-financed assets, savings accounts in banks that failed. There is something almost spiritual about how this pattern repeats across generations. We live most of our lives in periods of relative stability, where the sophisticated financial system works smoothly. Your bank account is safe, your government bonds are secure, the currency in your wallet buys roughly what it bought last year. That stability creates cognitive blindness to the possibility that the system itself could fail. We start to confuse the financial representation of wealth with actual wealth. And when the system fails, the terrible clarity returns. Real wealth is real things: food, land, skills, hard money, the things that were wealth before the system was created and remain wealth after it fails. Now let me bring this full circle and give you the most important takeaway from this entire discussion. The purpose of understanding these 6 assets is not to make you paranoid or to predict imminent collapse. It is to make you anti-fragile, a term from Nassim Taleb's work describing something that grows stronger under stress. A portfolio with meaningful exposure to these 6 categories, in proportions appropriate to your situation, is not just protected. It is positioned to take advantage of the opportunities that collapse inevitably creates. Every financial collapse in history created enormous wealth for some people. The people holding assets that were scarce when everything else became abundant. The people who had gold when everyone else had worthless paper. The people who had productive land when food became precious and scarce. The people who had rare skills when desperate economies needed problem solvers and builders. The goal is not merely to survive the collapse. The goal is to be positioned on the right side of it. To do that, you must prepare before it happens, not during and not after. If this video has given you clarity or urgency, take at least one concrete step today. Think about how you would diversify across these 6 asset classes in a way that fits your income, age, family situation, and country. The configuration that makes sense for someone in Argentina is different from someone in Germany or the United States. But the underlying assets, gold, productive land, storable commodities, hard foreign currency, equity in essential businesses, and rare high-value skills are universal. They have been universal throughout human history, and the odds that they suddenly stop working in future crises are essentially zero. If you found this video genuinely useful, I want to ask you to do one thing: share this with someone who needs to hear it. The knowledge here will not help much if only those already focused on financial resilience hear it. The people who most need this information are often the ones not yet thinking about it, the ones with savings entirely in a single currency or single financial system without historical resilience. That person might be a parent, a sibling, a close friend. Share this with them and start that conversation. Because the best financial protection in the world is not something you build alone. It's something you build together.